Hey everyone. Not too many of you this time. I don't know how well the notifications went out on eToro this time around. But regardless, I'm sure everyone will watch it on YouTube. So you guys get priority questions, I guess, for everyone that made it here. Super late Q4 quarterly update. There's been a lot going on in real life, a lot going on in the markets. It's been a busy start to the year. My next update is already scheduled, so if you check on my eToro feed, then you'll see when that is. So that one won't be late. You don't need to worry. We'll have some slightly more recent content to be talking about. But this is about Q4 from 2023, so the end of last year. Before I get into it, then I've got to go through the disclaimers as usual. None of this constitutes financial advice. I don't understand your personal situation, so please keep that in mind when you're going through the presentation. This is for marketing purposes only. All of the opinions expressed are my own. I don't represent eToro. I think that's more or less it. If you're using eToro, then your capital is obviously at risk, whether you're copying or not. So keep that all in mind. I have to get those things out of the way. Okay, let's get started. So as usual, I'll go through the usual steps. A brief introduction about me. Talk about my strategy a bit. We'll talk about performance and the markets overall, and how things went through the quarter and for the full year. I'll talk about some of the trading highlights and the news that really drove markets through the quarter. And at the end, I'll go through a quick kind of summary of where my thoughts are for the upcoming quarters and future events and the themes really that I'm looking at in the portfolio. At the very end, we'll have a Q&A. So if you have any questions, feel free to throw them in the chat and I'll try and answer them before we get to the end. Well, when we get to the end, I guess. So this is me, as you can tell, with Yoni there at a Popular Investor event. I didn't manage to make it to the last one, which is very sad, but I'm hopeful to make the one later this year, wherever that may be. I have over 13 years of experience in investing now. I started out self-taught. I always tell myself that I'm going to change that because I'm no longer fully self-taught. I've taken several qualifications from the CISI, including some extra stuff for ESG investing, to make sure that I'm very well qualified to be taking decisions with so much money behind me. My compound annual growth rate since joining eToro is over 31%. Which is higher than the likes of Warren Buffett and all of the other kind of big name investors that you've probably heard of. Whether or not I'll be able to keep that up for quite as long as Warren, I'm not sure, but that's the goal. A big part of how I invest and my kind of ethos in investing generally is ethics and kind of future thinking for the world. I try to invest with a methodology of making sure that the companies I invest in are generally positive for the world and for society as a whole. So I don't invest in things like firearms or drugs or anything like that, really. So fossil fuels as well. So something else, I guess, that's worth knowing about me. My background before I started doing investing was in gaming and events. I was a professional gamer, but back before it was cool, before I earned the big money doing this job, and before you could earn big money doing esports. So really, I didn't win too much prize money, but it was an awesome time. I got to experience a lot. And then I moved into event management and esports management, where I worked all the way up until 2017, when I quit that job to do this full time. So since 2017, I've been working full time, doing precisely this, looking at the portfolio on a daily basis and managing it and trying my best to beat the markets and provide good returns for everyone that's copying me. Some quick stats. So the actual CAGR number for this year is 31.14%. For this year, for the lifetime of me on eToro, I should say. So that compounds up to a lifetime return of 1,400% or so. I have over 15,000 copiers, and I have over $60 million of assets under copy. So quite a lot of funds from other people to be to be looking after, and trying to make work for them and generate a good return. My strategy basically revolves around identifying future trends. I tend to invest in disruptive technologies or innovative business models and products that are new and kind of pushing their way into the market. So I'm a growth investor. I'm very product orientated. I spend a lot of time researching the products. I spent a lot of time researching the various products that we're investing in the portfolio. I think that really gives me quite a big advantage over traditional Wall Street investors who are much more focused on the numbers and on the charts. I think that unless you understand the products, it's quite difficult to really understand if it's going to be disrupted or if it's going to be doing any disrupting. So that's something that I spend a lot of time on. Of course, look at all of the fundamental analysis, looking at the balance sheet, the cash flow statements, all of that kind of stuff, quarterly earnings reports, 10Ks, and making sure that I'm very much on top of the financials. I think financials only tell you so much, so that's why product is before that. I think product is actually one of the more important things to understand, making sure you understand the story of the company and where it's going. I also then vet every investment for ESG criteria. So I don't have strict rules yet. I'm actually still working on trying to formalize the rules into something a bit more easy to digest so that I can share that a bit more openly with all of the people copying me. But for the time being, it is a bit of a case of reading through the ESG statements from the different businesses and their strategies around that, checking ESG scores from various providers, and really taking all of that information and coming to a decision on my own about whether I think it's a good and sustainable business or not. Portfolio fit comes next. So whenever I make an investment, I try to look at how it is correlated with the rest of the portfolio and how it would impact my beta, so essentially the risk level against the benchmark that I primarily use, which is the NASDAQ 100. And then lastly, I spend a little bit of time looking at sentiment. That can be everything from social media to news articles and things like that, or even, of course, it's kind of combined with the technical analysis, looking at the charts and seeing what other investors are really doing around that investment. So those are the final two things. I'd say that those are by far the least important. I spend the least amount of time on. But yeah, that should be a broad kind of overview of my approach. So Q4 portfolio themes are, if anyone remembers the last quarterly update, they are basically exactly the same. Nothing has changed. There are, of course, a few other different companies that don't really fit in these categories that are in the portfolio as well, but broadly speaking, these are the categories that I think matter most. And there is, of course, some overlap between things like semiconductors and technology, or AI and technology. Semiconductors, I've been a big investor in Intel recently, this quarter especially, and before that in AMD and NVIDIA for a very long time. I've been investing in AMD for about 6 or 7 years now, and NVIDIA was actually one of the first stocks I ever bought on eToro. So it's been a bit of a wild ride watching that whole situation unfold. Tech-wise, obviously, I'm invested in companies like Microsoft and CrowdStrike and Amazon, Google. So yeah, there's a lot that could fit under technology. There's also some smaller businesses as well. But generally speaking, I think these days it's pretty hard to have a portfolio of any kind that doesn't have exposure to technology that will still generate good returns. Renewable energy has been something that I've been investing in for a long time as well. Probably around 2016 or so is when I started to invest in a lot of solar and wind companies. Solar especially has had a pretty tough time of the past couple of years since interest rates have gone up, but it still remains a sizable chunk of the portfolio. I'm still really bullish looking forward at where those businesses are going to go over the next 5 years or so. So I still hold quite a bit of exposure. AI is obviously the kind of the trendy new shiny thing. I think most of my AI exposure comes through large tech companies, so the likes of Microsoft and Adobe, for example. But generally speaking, I have exposure to them through data center things, through cybersecurity, like CrowdStrike. There's a lot of kind of different areas where AI is certainly present in my portfolio, so there's quite a lot of exposure to it. Building materials is next. Building materials is not something that you would generally think of as being really consistent with growth investing, but Boys Cascade, which I've got pictured here, was actually one of the best performing positions in my portfolio last year. It beat the NASDAQ 100. I think there's a lot of innovation going on in that industry at the moment, so it's kind of overlooked by a lot of investors. A lot of growth investors just don't even really look at that industry. So yeah, I've got quite a bit of exposure there. And then finally, there's electrification. So this has been a big part of my portfolio for a really long time as well now, but especially the past 4 to 5 years, I would say, where companies like ABB, Encore Wire, which is pictured here, Eaton more recently, and a few others have kind of featured in the portfolio. And again, those businesses are generally seen as quite stable and slow. So again, they're being overlooked, I think, by growth investors because they think that they're quite boring companies that will just pay you a small dividend and not really grow too much. But again, they've outperformed the S&P 500 very comfortably, and some of them have outperformed the NASDAQ 100 by a good margin as well. So I'm pretty happy with those kind of themes. Taking a look at performance. So performance for Q4 2023. We did pretty well. As you can see, we beat all of the benchmarks for the quarter, which is good because we didn't do that for the rest of the year. So we had to try and at least catch up a little bit of ground. The start for 2024 is already off to a good start, and we're beating the benchmark at the moment. But there were quite a lot of changes that I made to the portfolio in Q3 to try and address the issues of underperformance, especially a lot of the underperformance that was caused by my exposure to solar and renewables, and also some of the more stable companies that I put in to get us through 2022 in good condition. So it looks like that has worked. My beta for the past 6 months or so is pretty healthy, as is my Sharpe ratio. My Sharpe ratio so far this year is actually around 7.5 or something like that, which is crazy. Sharpe ratio, for those of you that don't know, by the way, is essentially a way of measuring your returns compared with the risk against the benchmark. And yeah, it's looking pretty healthy at the moment. So yeah, I think the things to talk about here, probably the most interesting trend on this slide really is the outperformance of the European stock markets. So again, this is a lot of companies that aren't quite so techy. They're a bit more industrial. They're kind of been overlooked a bit, but in reality, most of those businesses can also benefit from things like AI. The reduction in oil costs also made quite a big impact in Europe in terms of production manufacturing, especially in Germany. But yeah, I mean, really, there's not too much to say about the quarter. I think it was bullish overall, no matter where you are investing. So everyone should have made money more or less in Q4, but thankfully we made more than the market, so that's good. For the full year, the picture's not quite so pretty. We're a bit closer to the FTSE and the Russell 2000 than we are to anything else. Certainly pretty far behind the NASDAQ. I think it's worth pointing out with the same thing that I pointed out in Q2 and Q3, which is that the big 7 kind of tech companies, which is Nvidia, Tesla, Microsoft, Apple, Amazon, Google, and someone else that I can't remember at the moment. Facebook probably. They really were responsible for the vast majority of those gains. In fact, I think the Nasdaq is almost at a point now where it's becoming a bit of a poor benchmark and actually quite a risky thing to be investing in because of the extremely high weighting towards the top 5 to 10 companies in that index that make it up. So although I underperformed it for the year, I'm not really too unhappy that I underperformed it. I think I would have underperformed it even if I had performed better and managed to avoid some of the losses from solar and renewables. But that being said, I still underperformed the Russell 2000, which did not have a really great year either, and I underperformed the S&P 500, which I think is probably a much more broad kind of sensible benchmark to be looking at in these kind of periods where there's quite a lot of hysteria and hype in the markets. So yeah, there's not too much I can say about that. Really, most of that was caused by Q1 and Q2, where I underperformed quite substantially. Q3 was relatively balanced. I did okay, and Q4, as you just saw, I beat the market very slightly. So yeah, it just shows the power of compounding, really. The poor performance at the start of the year really cost me quite heavily later in the year. Q4 market highlights. I think there's a few we can talk about. I'll start with Bitcoin. So Bitcoin obviously has been trading way down in and around the 30s and the 20s even for quite a long period through 2023, and in 2024 it finally made its big move upwards. Obviously, the catalyst for that was the launch of the Bitcoin ETFs, the approval of the Bitcoin ETFs, which have seen massive inflows from institutional investors into the market. This paves the way for Ethereum ETFs and probably some other crypto ETFs, maybe even some broader kind of crypto indices or funds of some sort that kind of collate a few more cryptocurrencies. I didn't really have too much exposure to it, just so you know. I don't invest in Bitcoin because of its impact on the environment. I do hold Ethereum though in the portfolio, and I am bullish on that as well. I think that that's still got some way to go. On top of that, there's also the halvening event for Bitcoin coming up, where the supply that's produced each year is going to be cut in half again. And usually that's the way Bitcoin kind of works. It has these sort of 3 to 4 year long cycles of growing and then crashing back down and slowly building back up to restart again. Another thing that drove markets through the quarter was oil prices. Oil prices pretty much, I wouldn't say collapsed, but they plunged pretty heavily through Q4. I think this obviously is, as I mentioned, something that's had a big impact, especially on Europe, where oil prices are quite strongly correlated with the costs for a lot of big manufacturers and industrials. So this was generally pretty good news for the market. I mean, unless you're investing in oil companies, I guess. That being said, OPEC is still working on trying to cut supply of oil quite a lot over the past year or so. In fact, they've been pretty consistently trying to cut supply so that they can boost the prices up a bit more. That will have an impact when it eventually kind of hits the market, but I don't really expect that to be a problem until well into the second half of this year at the very earliest. US indices closed at new all-time highs. They just kind of pipped it out at the end of the year. Did really well. The EU I talked about already. Q4 they rebounded. You can see there in that chart. I think that is the FTSE 100, the German 30, and the EU Stocks 50 indices that are shown on that chart. Sorry, but the text is too small for me to tell you which one's which. I'm pretty sure the FTSE will be the one that's doing worst. Another big headline through the quarter was what was going on with OpenAI. There's all sorts of shenanigans going on with Sam Altman, who was pushed out of the board and then came back into the board, and Microsoft were trying to offer him deals to just come to them and all sorts of things. It ended up kind of balancing out again, and everything more or less ended up back where it started. But it was a lot of drama, and probably explains why there was a little bit of underperformance in the AI sector in Q4, slightly. Certainly from companies like Nvidia, which has had these huge growth spurts throughout the year, but were actually somewhat flat through the quarter. And last of all, Microsoft finished their merger with Activision Blizzard, or acquisition of Activision Blizzard, I should say. So yeah, pretty big news for the gaming industry. really kind of sets the tone for what's likely to come in the future, which I think is more consolidation under just Sony, Microsoft, and possibly Nintendo, but predominantly the former of those three. In terms of the portfolio, there were some pretty interesting highlights, some pretty good ones. I was extremely happy to see major outperformance by the three kind of large electrical manufacturers that I have in my portfolio, which is Schneider Electric, ABB, and Eaton. The three of them, the three of them outperformed the Nasdaq, and two of them were over double the Nasdaq's Q4 return. They also have outperformed throughout the year. Really pretty proud of this investment in terms of the things that I look at in the portfolio the most. It's a pretty big allocation between those three companies. There is some kind of diversification there by having three different businesses that compete with each other. And of course, some of them do more than just electrical equipment, especially ABB. But they have good exposure to things like data centers. They have good exposure to a lot of the kind of growth that we're seeing in electrification generally, and some of the innovation that's going on in grid services and things like that. So yeah, they've done extremely well over that period, and I'm really confident they're going to continue to do that. Solar struggled again. Both Enphase and SolarEdge had poor earnings yet again. That again really hit the portfolio quite hard, but I had taken steps in Q3 to reduce it, and Q2 even, to reduce exposure to them quite a bit. After their earnings, I did start to rebuild the exposure quite a lot. So they're now much bigger positions again. I think Enphase is probably about my 6th largest, and SolarEdge is somewhere around my 10th largest position. So hopefully later this year, as interest rates continue to kind of slowly taper off, and the market for solar and wind and other renewables even someone misclicked stream to Twitch. Yeah, I don't stream on Twitch anymore. They have ads. Yeah, so I think we're going to see a rebound and a recovery in this industry at some point. They've fallen a very, very long way, something like 80% down at one point, possibly even more than that for SolarEdge. So I think there's loads of growth ahead. You're looking at like 400, 500% over the next 3 or 4 years, being a pretty conservative estimate, I would say, on what I'm expecting from those businesses, which is why I've held them in the portfolio. I don't want to miss out on the returns that they're likely to generate. Some other interesting news for our portfolio. Wasn't really big news, I guess, because it's a reasonably small position in the portfolio, but I had exposure to both Six Flags and Cedar Fair, two theme park companies that are predominantly in the US, but are also trying to expand out beyond that. In the start of the quarter, Six Flags announced their plans to merge with Cedar Fair. This is actually really good news for a lot of reasons that are somewhat complex that I won't get into. I guess the summary of it being that Cedar Fair wasn't a typical stock. It used a very different structure for investing in them, which meant that we didn't have things like voting rights at all, and the taxation of it was much more tricky, and so it made it less worthwhile potentially to invest in, which is a shame because I felt like that was the best value of those companies in that industry. Both of them combining is actually pretty big news because they're going to become really a titan of that industry, and obviously they can consolidate their debt together and refinance it and get a better deal, make savings on a lot of the admin side of things, and I think it will put them in a position where international expansion becomes a bit more of a viable thing for them as well. So yeah, that's pretty good. The board approved it, I think, in December. So that should be completing quite soon, and Six Flags will be the ticker that's left on the market. Finally, StoneCo. So StoneCo has done really, really well. It's a payment provider in Brazil predominantly, but also outside of that, they're predominantly focused on small and medium-sized businesses, although they are starting to shift that exposure of their clients upwards a little bit. Yeah, 66% growth in Q4. I think that's really all you need to know. Pretty crazy. Okay, so moving on to Outlook. You know, this is what I said in the previous update. So in the Q3 update, this is what I kind of gave for H1. I think actually, if we read through them, you can see that they've pretty much been quite accurate. The UK has been flirting with recession, as have some other countries in Europe, as pointed out in the bottom one there. The electrification trend I got pretty bang on in terms of EVs. I said that I expect EV sales to slide now and start to struggle as there's more competition and the interest rates are higher. And I didn't really see companies like Rivian or even Tesla doing very well. Tesla just came out with disappointing numbers yesterday, I think, or the day before yesterday. So yeah, I'm pretty happy that I called that one, and I reduced my exposure to EVs very substantially long before this. So we didn't really get affected by that at all. If anything, maybe there's an opportunity later. And the soft landing in terms of the reduction of interest rates, I think that's been pushed back a little bit, but generally I'd say that this was pretty accurate as well. If we go to the future outlook, you can see that I've kept two of those things in there, and I've added elections to the bottom to replace the recession risk one, because I think elections really is the big thing that's going to be impacting markets this year. There's a lot of big elections. We've already had quite a few of them. You can see them listed there, you know, UK, Belgium, South Korea, Mexico, India, Indonesia, the US obviously being the biggest and most pivotal and the one that's going to make the biggest impact on the markets. There's also really big policy implications from these elections, depending on who gets in various countries. That could impact policy around what's going on in the Middle East with Israel-Palestine, or further down where there's conflicts around Yemen and Somalia and things, with the kind of piracy for shipping, which makes a massive impact on global markets. So yeah, there's a lot really that could happen as a result of some of these elections. So this year is definitely a year to be monitoring all of the big countries, but especially the US, to see how that unfolds. The EV slowdown, I've written a bit more about it here. So I think it's pretty clear that that's now a thing that's happening. Even today, Ford, which is one of the companies in the portfolio, announced that they're kind of reshifting some of their attention back towards hybrid vehicles instead of EVs because of the lack of demand. They've postponed one of their new EVs that they were working on. There are other companies doing similar. So this is obviously going to be quite pivotal for the auto industry. But I think that also gives a good opportunity to companies that are investing more in their supply chain for electric vehicles, because eventually I do see that turning around. Really, I think a lot of the slowdown is to do with oil prices. And although oil prices are still pretty low, OPEC is still working on trying to push that up, and so you know that may change. And again, talking about the soft landing in terms of interest rates, I think realistically, when you look at it, it's going to be 2025 before we start heading down to the kind of 2% range that everyone has been talking about for so long as being the target. It may not even get that far potentially. Really, the US is leading the way. The UK, I think, is lagging quite far behind, and Europe as well. I'm not sure that we're going to see them do much more than hold them flat for most of the year. So it's probably going to be 2025 before we start seeing Europe and the UK moving in the right direction. I think I may have gone through this a bit faster than normal. I'm not sure. No, we're pretty good on time. So that's all for this update. As I mentioned at the start, I'm already working on the Q1 update for 2024. That's already scheduled in for a couple of weeks' time. So go and check the feed on eToro and put it in your calendars if you want to tune in for that one. Before I start taking questions, which you can feel free to start asking if you want, I will just point out that my name on all of the different social media platforms pretty much is just Jaynemesis. If you see anyone that doesn't have that username, and I mean username, not display name, that's not me. So please be really wary. There have been plenty of people impersonating me on Discord, especially trying to get money out of people. There used to be a lot on Instagram, I know. I try to avoid even going on there anymore, to be honest, because of how bad that got for a while. But yeah, just be vigilant and make sure that you're kind of paying attention to who you're talking to. Obviously, I don't have enough time to talk to every single copier and come to you with individual promotions or anything like that. eToro is the only place that I do any sort of copy trading. I don't do any financial advice. I don't really do much in crypto anymore. So yeah, if you see any of those things, they're red flags, and you should be wary. Okay, I'm going to try and answer a few questions. And once that's done, obviously, I will close it down. The video for this will be available after, well, probably tomorrow, to be honest, because I have to, do a little bit of like tinkering and editing and description and things. So tomorrow, at the very latest, this video will be up for anyone who missed it or joined late to watch as well. Okay, so Juice has asked, am I concerned if Trump is re-elected, it will be negative for the solar positions as his policies aren't eco-friendly? I don't think it's so much that it will be negative for solar. Generally speaking, the thing that's hurting solar the most is that it's a capital-intensive investment, right? Even if both at a kind of grid scale solution and also for rooftop solar. And the same is true for wind. It takes a lot of money to put up wind turbines or buy the solar panels and install them and set up the inverters and everything. And when you can put your money in a bank or you can put your money into, US treasuries or something like that and get a return of 3 or 4% a year, it's very difficult to justify putting it into solar to earn maybe 5% a year. The justification in terms of risk for reward is not as good. So that's, I think, really the main thing that's kind of holding it back. So as long as interest rates come down, which really Trump is unlikely to have that big of an impact on, then solar should still do well over the coming few years. It may well not be until the tail end of the year that we really start to see solar doing better. But yeah, I would say that things like electric vehicles and things may be the thing that suffer a bit more from Trump winning than solar. That said, I do think Trump is something that could be pretty impactful in terms of policy for Russia-Ukraine, which may have knock-on effects on Europe, on military spending, on policies within those countries, some of the trade things that are going on, and of course then potential knock-on effects to what's going on with China and Taiwan, for example. So yeah, there's still a lot to consider about Trump being elected, but I would say that solar is the thing that I'm not least concerned about, but it's not something that I'm really as concerned about. Can you discuss UI? They're at the end of. Are they at the end of the decline? Yeah, Ubiquity has been a thorn in my side for the past 3 years or so. It's a very unique, yeah, it's a very unique company in terms of the float on the market, the leadership, the amount of transparency that there is on what they're doing. I think really, I still look at their products, and I even looking at the kind of growth we're seeing in data centers and AI, I still see them as really compelling. It's just difficult because you don't have much information. They don't really share any plans because of the fact that the CEO owns 90-something% of the company, and we get the dregs to trade with on the market. I think realistically, it's one of those positions that so I've scaled back my position in it quite substantially over the past year or so. It used to be a pretty big position, and it was performing well for me. They ran into a lot of supply chain issues. I think competition got a bit fiercer, both on the kind of the server equipment and some of the other products that they do around security and things like that. But generally, I still find them to be a really good kind of product lineup, with good margins and a good kind of ecosystem that they're building out. So I'm kind of happy to just sit in it for now. It's a smaller position. Uh, there is still a chance that it continues to slide for a while longer. I think especially companies that have low liquidity and lower market caps can be overlooked by the market for quite a long time. So there's not really as much kind of drive from analysts to drive investors towards it, and there's certainly a lot less institutional investors that would look at a business like that. But it's somewhere that I'm gonna kind of keep in my portfolio, I think. Um, can I describe why my eToro risk is at 5 and what drives this? So this is going to be potentially a bit of a controversial answer. So the eToro risk scores are based on more or less on standard deviation over like I think it's a rolling 30-day period for the assets in your portfolio, but it's based on the amount that you invested into those positions when you opened them. Generally speaking, I've always taken the viewpoint of cycling my positions in my portfolio relatively frequently, which means that my invested amount and the value of that invested amount have always been quite similar historically, which means that the risk score has been quite accurate for me. When you look at other popular investors on eToro, I think it's worth looking at how old some of their positions are and what the difference is between the amount invested in the position and the amount the position is worth. If there is quite a big discrepancy there, then it means that the risk score will not be as accurate. So, for example, you could put 5% of your portfolio in the start of 2021 into Nvidia, and it would have increased by maybe 1,000% or something almost. So that means that within your portfolio, assuming that your other companies were relatively flat, potentially Nvidia is worth something like 40% of your portfolio. If that's the case, then the risk score should be several times larger than when it was only 5% of your portfolio. But that's not how the risk score works. The risk score still bases it on the original amount that was invested. So that means that it would show a much lower amount of risk associated with that Nvidia position. So that's one thing. Another thing is that because it's based on essentially volatility, risk scores can sometimes show something as being high risk when in reality it's quite low risk at the time. So if there's a big drop in a company over a certain time period, but the fundamentals of the business haven't really changed much and the outlook is still the same, the risk score will mark that as being a more risky part of your portfolio. But most sensible investors would look at that and see that as a buying opportunity for that investment, and that it's much more likely to produce returns rather than drop further. So both of those things play an impact. Generally speaking, my risk score has always been at an average of around 5 historically. So yeah, I don't really plan on changing it. I think I hope that eToro is working on addressing the risk score. I know they've worked hard to address some of the other small kind of niggles with the copy trading system, and now they've made that incredibly good and very very efficient now at reallocating funds and things like that, which makes it much more fair. So hopefully they're planning on doing the same to the risk score, and that will solve the problem. And you will probably see a lot of other popular investor risk scores jump higher than mine is. I guess one other thing I would say is that if you want to kind of look at risk adjusted returns or even just kind of risk more broadly, then looking at the beta of the portfolio, which you can see on PI Screener, which is a website that was made by another popular investor, or the Sorrentino ratio or the Sharpe ratio. All of those will give you a much better kind of indication of how risky a portfolio is and how well diversified it is, how it should perform against a risk-free rate of return. Okay, good to know. Well, hopefully I taught you a bit about the risk score. Why are renewables doing so badly? Okay, so renewables are doing badly mostly because of interest rates, as I mentioned earlier. I don't know when you joined, Luther, but yeah, I think really it's around interest rates. When interest rates are high, like they are at the moment, especially in Europe, the return on investment that you make for constructing a solar farm or a wind farm drops dramatically. On top of that, there's also been a lot of problems in supply chain and commodities, especially in wind. So in wind, the kind of general time frame that you'll be looking at from completing a signed deal for a bunch of wind turbines from a company like Ørsted or VWS or someone like that, you would expect to wait maybe 2 years, maybe even 3 years before you would get that wind turbine. And so what happened was, as commodity prices were very expensive, the companies that were producing those wind turbines eventually got around to building them to deliver to those customers, and found that the profit margin had essentially been eroded completely. I think it was Ørsted recently that wrote off a really, really big deal for a wind farm in the US because of this, and they just decided that it was less expensive to pay fines and give up on the order and give that to a competitor than it was to fulfill the order and actually build those turbines for that particular wind farm. So that's happened quite a lot. And then, as I said, interest rates generally just mean that the capital expenditure, which is usually debt, essentially, borrowing to build these kind of things at a 4 or 5% interest rate, possibly higher, is just not that worthwhile when it's going to be a project that's going to take 15 to maybe even 20 years to pay itself off. It just doesn't really make sense to do that when you could just keep the capital available to you without spending it in a bank account or in some sort of savings product on the market. Has the crypto market just started, in your opinion? Yes and no. I'm going to give a non-committal answer on that one. I think that it's likely that Bitcoin will end the year, closer to 100K than 70K. And I think that Ethereum is likely to end the year higher as well. But I would say that broadly speaking, the altcoin markets, while I expect there to be some big growth in some of those altcoins, generally I think investors have kind of learned now that a lot of the altcoins, NFT projects and things like that really didn't have much supporting the valuations. So I don't really expect too much outside of the top 10, top 20 cryptocurrencies to be investable for me. I don't plan on making them a big part of my portfolio either. And part of that also is that the eToro now have some slightly different situations in the UK, which is one of the big countries in terms of my following, where copiers won't actually copy the positions of cryptocurrencies due to recent regulations that were introduced by the FCA in the UK. So yeah, there's not too much chance of me increasing my crypto exposure. I do have a little bit. It'll be unfortunate that UK copiers won't necessarily get to benefit from those positions, but broadly speaking, it's not enough that it should make a tangible difference to their performance, a major difference to their performance compared to mine on eToro. And hopefully, eventually, the regulators and eToro can work together to figure something out. Okay, I don't really see any more questions. So, and to be fair, it's almost at the hour mark, which is usually where I try and stop. As I mentioned, please be wary of any scammers on social media. they're impersonating me. The video for this will go up by tomorrow, and also you can check out my portfolio on eToro if you haven't already. If you're not copying, then please consider it. If you are copying, consider adding more funds. I'll be doing that to my own account soon as well. There's a post on eToro that details that. I plan on producing a bit more content, and of course the Q1 performance update is nowhere near as delayed as this one was, so we'll be in a couple of weeks' time. So yeah, put it in your calendars, and I hope to see you guys for that one. Okay, that does it for this one. Thanks for joining, everyone, and I will see you all at the next one. Thanks. Bye.